Hello and happy Wednesday, September 23rd. Welcome back to another exciting edition of Rate Desk. I'm your host, Michael Thomas, here to talk about multifamily interest rates and other news. First, going over to the markets, all three of the major indices are in the red today, closing down for the session. We have seen some volatility of late, and we've seen the stock market come down. Have not seen a big increase in the buying of U.S. Treasuries, and as a result, the yields are flat on the U.S. 10-year, 0.67, just where they were last week, if you recall, 67 basis points. On the crude oil futures, we are seeing them relatively range-bound in the $39 barrel range. They were 40 last week, so nice to see them kind of hanging in there in that range. Jumping on over to the multifamily interest rates, got some good news there. Not a lot of changes, still historically low interest rates in multifamily. Jumping on over to the FHA 223F, that is at 215, 2.15, fixed for 35 years, and the 221D for sub-rehab construction loan, that is at 2.75. Now remember, that does not include the mortgage insurance premium, the MIP. But still, even adding that in, you are looking at an incredibly low interest rate environment for FHA. Going on over to the Fannie desk, got some rates today from my friend John, and hey, we're looking relatively range bound as well on the Fannie Mae. Today we're quoting at 269 on the 10-year. That is a 10-year fixed Fannie Mae loan, 269. And Freddie Mac quoting high at 311, but in reality, they're probably also somewhere in that 290 to 311 range. They just don't always like to deliver lower rate quotes. They're on a case-by-case basis. So both agencies and FHAs delivering very low interest rates. Got some news on the August rents going up by $1. That is nice to see. Year over year, of course, we're seeing a slight decline in rents, but nice to see that they were up in August. It seems to be that the major markets have been truly hit the hardest by this. A lot of the institutional equity that's in markets like San Francisco or New York City, they've pulled back. So, 22 out of the 30 major markets are seeing some negative rent growth there currently due to people pulling up shop and moving further out, right, of the urban core. So we'll see how that plays out. We've talked a lot about suburban housing and the importance of that sector as we continue on. Just saw some news too reported out that the multifamily permitting is down. Less permits are being pulled. Probably more a reflection of the capital markets than anything currently. As we all know, the banks do tend to pull back in times of uncertainty. Construction lenders definitely pull back, and housing construction lenders most certainly do pull back in the multifamily sector. So that might be somewhat of a reflection there. I can tell you on those that are comfortable with the FHA program, the non-recourse construction program, they're just seeing unprecedented volume, right? Again, this is a pretty common occurrence in a counter cycle for HUD FHA to become very, very busy as a result of the other capital market sources not being available. That would include bank construction lenders. So if you've never tried FHA, now might be the time to take a look and see if you could make it through the HUD FHA system. We'll keep you building. It will keep you active during this period of uncertainty. Frankly, we don't know exactly where the economy is going to land as a result of unemployment, etc. We do know this. We do know that we need to build more housing, period. Single and multi, for sale and multi. And in particular, we really do need to build a lot more multifamily housing to house our population. There's also ways to renovate and rehab and go out and get some of those C-class properties. I talked to an owner that has a business plan where they go out and they develop the C assets and take them up to Bs, and it's great. Again, coming back to that workforce housing. So look for those opportunities. Remember, HUD FHA is out there and a source for construction financing. Stay tuned. Come back and see me next week. Thank you all so much for coming to watch me here at Rate Desk for another exciting edition. I am your host, Michael Thomas, signing off.